Have you ever wondered how Warren Buffett, one of the world's most successful investors, transformed a few $1,000s into billions? Warren Buffett, a name synonymous with enormous riches and investment skill, has a method that has fascinated and inspired millions around the world. The concept of investing like the great Warren Buffett is maybe more accessible than most people believe. Many people seek Buffett, dubbed the Oracle of Omaha, for advice because of his straightforward but effective financial technique. New investors, expecting a more complex plan from such a well-known figure, are frequently surprised by its simplicity. The essence of Buffett's strategy is to identify high-quality companies with a market price that is lower than their true worth, and then hold on to these assets throughout the duration of their great performance. Although Buffett's investment strategy appears straightforward at first glance, there are certain intricacies to it that are not often understood. Although we don't know his particular investment technique, we are aware of several of his widely used guiding principles. First, a margin of safety is a crucial component of Buffett's approach. This technique comprises looking for investments that provide a safety net to lessen the risk of loss. For example, if a company's assets are worth $12 a share, but the stock is only $12, this $2 differential works as a buffer against a potential stock price collapse because it implies that the stock is undervalued. In the words of Warren Buffett, a too high purchase price for the stock of an excellent company can undo the effects of a subsequent decade of favorable business developments. This comment emphasizes his goal of investing at a discount to a company's intrinsic value. Second, Buffett is quite particular about the companies he backs. His approach is to ignore low-quality enterprises, regardless of how appealing their prices are. One notable example is his investment in Coca-Cola. He didn't choose this legendary firm because it was struggling and cheap. Instead, he saw strength and potential in it. According to Buffett, buying a fantastic company at a fair price is preferable to buying a decent company at a fabulous price. Furthermore, Buffett warns against following fads in the investment sector. This is especially crucial in the present era of technology, as internet platforms have a considerable impact on market patterns. His decision to invest in Apple, which was considered a daring move at the time, serves as an example. He didn't invest in the company simply because he thought it had promise. He saw something extraordinary that others might have overlooked. According to Buffett, independent thought is important, as is the pursuit of value through analysis rather than market caprices. Buffett also places a strong emphasis on an investor's temperament. He believes that the best investors are those who can remain calm in the face of adversity. It is vital to keep your emotions in check and not let them influence your investment selections. Moreover, Buffett's response to a weak market demonstrates his overall investing philosophy. Buffett sees market corrections and collapses as opportunities, but most investors react with panic and sell quickly owing to herd mentality and fear of further losses. He compares it to discovering a 20% discount on everything at your go-to store. Buffett sees market changes as opportunities to buy high-quality stocks at a discount, rather than a catastrophe. For example, Buffett did not avoid the market's volatility in 2022. Instead, he purchased equities at a discount. "Opportunities come infrequently," is his famous adage. "When it rains gold, put out the bucket, not the thimble," demonstrates how he seizes enormous opportunities instead of being cautious. Keeping an eye on the larger picture is critical to Buffett's investing strategy. He does not invest for rapid riches, but rather for the long term, intending to hold onto his stock holdings for decades. If you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes. This advice precisely reflects his thinking. This method reflects a belief in investing in companies rather than simply trading stocks. Buffett is in the stock business, but he is more interested in long-term ownership. This is proven by his recommendation of S&P 500 index funds as a simple, worry-free long-term investment strategy for the majority of individuals. Another factor contributing to Buffett's success is his understanding of the value of compounding. He achieved tremendous growth by reinvesting dividends and taking advantage of Berkshire Hathaway's operating cash flow. Berkshire Hathaway has outperformed the S&P 500 with an average annual return of 20.1% since taking over in 1964. This method has resulted in a total gain of $3 million, 641,613% for shareholders, outperforming the S&P 500's gain of 30,209%. This underlines the importance of long-term compounding for investment development. Finally, one of the keys to Buffett's investment success has been his dedication to research and introspection. In his Omaha office, he spends hours reading and thinking. His commitment to studying and considering investment opportunities is a critical component of his strategy. According to Buffett, the capacity to make informed investment decisions is similar to a compounding asset. Knowledge. When it comes to investing, his method emphasizes the importance of thorough research and continuous learning. So that is all the time we had today, folks. Hope you enjoyed this video. Do not forget to subscribe to our channel and hit the bell icon on your way out. See you all next time.